the trends, let's look at it. Infosys is today at a 52-week high. So this is the point I was making in the morning, that it's no longer Reliance. Banks were the leaders. Reliance is the leader. But will the B10 now press move from banks to Reliance and Reliance to IT? Well, IT index in the month of July itself, it's been a long series, on the July series, is up more than 20%. Now that's unheard of, an index giving you a 20% return, which does not have Reliance, right? IT indexes, Infosys, TCS, Wipro, HCL Tech and Tech Mahindra. These 5 stocks cumulatively have given a powerful punch to the market, something which we don't talk about it because we in a sense have been really focusing our attention around underperformance in bank and massive outperformance in Reliance. Let's look at some of the IT stocks in the last 1 month. My producer will start firing all of them one by one. TCS, Infosys, Wipro. Post numbers, Infosys in a sense, post the management commentary, the stock got galvanized. It's moved into a different orbit altogether. So now even technical traders are taking notice of it. Fund managers by and large who are underweight Reliance have used IT as a comeback trail. They're using pharma in order to catch up with the index, because with Reliance you cannot go above 8-9% for risk reasons, and Reliance is 14-15% of the benchmark already. So the underperformance in Reliance needs to be compensated somewhere, and I think that largely could happen with a combination of IT pharma, because banks are also underperforming and you underweight Reliance. Now that's a perfect recipe of disaster for a open-ended fund where you are overweight an underperforming sector and underweight and outperforming stock. So that's the reason why IT and pharma in a sense really could come for a big rescue. Let me now connect with the management of Quess Corp to take the conversation forward and talk about quarterly numbers. Suraj Moraje, Executive Director and Group CEO with Quess Corp joins us. Suraj, good morning. Thank you for joining us. Walk us through the impact of COVID on your numbers, especially on the staffing and other segments.
Sure. Look, I mean, overall revenues, if you take a year-on-year view, our revenues have stayed flattish, which was a lower impact than we'd expected. On the face of it, our EBITDA is down about 12% year-on-year. But if you correct for some one-times, including about 6 crores of COVID-related costs and a lockdown impact of 21 crores on Excelus and the DigiCare business, including some impact on our food business, then the numbers, EBITDA performance is more or less flat versus a year ago also. So we're quite pleased with that. I think overall it's due to a 20% indirect cost reduction in the quarter itself, which is I think across salary and non-salary levers. So overall, we feel good. The OCF generation for the quarter is up about 2.39 times at about 148 crores, which also in the circumstances we feel good about. I think if you take a business by business view, general staffing, the headcount is down about 15%, just a shade under 15%, which is again sort of a little bit better than we'd expected or we'd hoped or feared, a little bit better than we'd feared, I would say. And the other businesses have a little bit less impact than that in headcount. So that's sort of an overall view.
So do you expect margins to remain in this range of about 5% for the rest of the year and for a couple of coming quarters?
Our margins have actually held up quite well. Again, if you correct for the Excelus and the DigiCare businesses, both of which had to shut down during the lockdown. One is a retail break fix business, the other is a training business. If you correct for those, our margins have stayed quite stable across the business. And we are looking to convert our cost reductions into kind of more permanent savings. So we get our business onto a different cost path going forward. We're also using this time to these savings are also being driven through digitization, automation, better technology, embedding in the business, which helps us go faster. So we think it's a good thing. They're all coming through relatively long-term, medium-term sort of objectives, although of course we're pushing them through very fast. So we do think that in the short term, there will be some price pressure, but hopefully that will ease as the economy grows. And we see our margins remaining quite stable at this point.
Suraj, hi there. Morning. While this may not directly impact your business, just want to understand, given that we have seen a massive exodus by the migrant laborers over the last few months, now with a lot of the factories and the establishments gradually opening up, is there signs of stabilization on the labor migrant issue?
So, I think we were a bit insulated from the worst of the market. Our customers are all large enterprises. So we have no exposure to SMEs or small businesses. We also have very little exposure to sectors that were really badly impacted, like tourism and aviation. And so actually, if you look at a total 15% headcount drop from the peak, that's nowhere close to some of the numbers you see in the newspapers. We think the segments that have been most badly hit are actually the daily wage workers and people who have informal jobs. All of our employees are on monthly wages, and so there has been a certain amount of security in those jobs. In general, they have a 30-day notice period before they can be let go of. Having said that, at this point, we are seeing signs that the labor market is turning. We've acquired about 200 customers in the last quarter, and some of them now seem to be ready to press the button on rehiring. Now, obviously, it varies week on week with every news of a lockdown or an open up. I think there's still a bit of skittishness in the market, but we're truly hoping that as we get closer to Diwali and the festival season, we will start to see the traditional volumes kick in again.
Okay, fair enough. So seeing some signs of stability returning. I wanted to also address the impact of the lockdown of training facilities. Of course, that would have had to been closed to a great extent. So how did that impact your workforce management revenue? And will this sector continue to drive growth?
So we, long term, we're very, very positive about the prospects of outsourcing in the grey collar space, which is largely where we play. We see a few things coming to play here. One, we see a lot of employers looking at how do they take these workers and manage them more effectively. Be it kind of reducing the costs of managing them, be it sourcing them faster, be it creating different shift patterns and techniques. So we're only seeing more conversations and more interest in outsourcing right now. So we're absolutely very confident about the medium-term prospects. In the last quarter itself, we acquired about 200 customers across the franchise, which is quite robust given the overall market conditions. And we do find that many more customers are showing interest in the fact that we have multiple offerings, from workforce management and general staffing to facilities to security to BPM. Now, at this point, about 68% of our revenues come from customers of more than two or more of our service lines. So we're absolutely bullish about the medium-term prospects. I think we just need to get out of this economic slump, and we expect to come out all guns blazing.
Sure. Within staffing and facilities management, which are the verticals then that have seen the most decline in headcount, and what's the outlook going forward now for these businesses?
That's a great question. I think if you look at the staffing business, the verticals that were most hit were retail and BFSI. And I think that, that was driven a lot by the fact that especially the last 2-3 months in several segments of retail and BFSI, there have not been field activities. See, a lot of our employees are mostly, if you look at workforce management and general staffing, a lot of our employees are really involved in frontline tasks. And the frontline volumes of work have come down in those segments. So that's where the impact has been on workforce management and general staffing specifically. In IT staffing, actually, we've seen less of an impact. Our headcount is down about 7% in the quarter, and that's largely because of some segments of BPO. We're actually finding that in the core sort of, let's see, IT skills, high-end IT skills, the demand is only growing. And so that business, by and large, is on track. If I switch to facilities and security services, I think there we're being impacted mostly in the IT services vertical, whereas as customers, as our clients' employees work from home, they need less of the night shift. They have fewer buildings being kept open. And in security, especially with the transports going down, they have less need for security people in the transportation vehicles at this time. We haven't lost a single customer. It's just that the customer needs have come down in this time. And as people start returning to work, we should start seeing the volumes go up. And in the meantime, we're just focusing on acquiring new customers to put ourselves in as good a position as possible when the economy picks up.
All right, we leave it there then for this morning. Thanks so much for joining us, Suraj. We need to take a very quick break. We'll be back with more on the other side.